All right, let's just jump right into it because today we're breaking down one of those mornings that just changes the entire market narrative. Picture this, it's Monday morning and everyone's waking up to some serious geopolitical shockwaves. The Dow is plunging on news of military action, and the one question on everyone's mind is, where is the smart money actually going? So this is what traders saw first thing this morning, a sea of red. Dow futures were absolutely cratering, down over 500 points before the opening bell even had a chance to ring. And what was the trigger? U.S. and Israeli military strikes hitting Iran. Now, this isn't just another headline. This is a massive market-moving event. And really, if you look at the market's reaction this morning, it all boils down to one single powerful word: war. That's what's driving the sell-off in stocks. It's what's causing the spike in oil, and it's behind the rally in bonds. Every single move you're seeing is being priced through the lens of this new reality. But here's the thing about panic. It creates distortions in the market. And for a calm, data-driven investor, that begs the real question, right? When the entire market is having this broad, knee-jerk reaction, where do you start looking for those specific, mispriced opportunities? So the most obvious play, the one everyone jumps to, is to just buy oil. But as we're about to see, that knee-jerk reaction might not be the smartest move you can make. And this slide really breaks down why. You've got these two powerful forces basically in a tug of war over the price of oil. On one side, the bull case. Yeah, military strikes are disrupting Iranian supply, taking barrels off the market. But on the other side, you've got two big bear cases. Reports are confirming other OPEC producers are already boosting output to fill the gap, and we're seeing a classic flight to safety. And that flight to safety is absolutely key here. When investors get scared, they dump riskier things like stocks and pile into safer assets, and that means the US dollar and treasury bonds. Now, here's the kicker. A stronger dollar actually pushes down on oil prices because oil is priced in dollars globally. So that oil rally, it might have a ceiling, which makes a pure bet on crude futures surprisingly risky right now. Okay, so if the obvious commodity play is a bit of a trap, where's the real opportunity? Well, it's in the chaos itself. This is where we need to stop thinking like a panicker and start thinking like a stock picker. And this quote just nails it. The crucial point is, when the market sells off indiscriminately, it throws the good companies out with the bad. An event like this literally creates value for anyone who has a plan and can look past all the noise to the underlying fundamentals of a business. So what does a plan like that even look like? Well, let's build one. We're going to create a 4-point thesis, a simple framework for finding energy stocks that are built to be resilient. Okay, this checklist is really the heart of the strategy. First up, obviously, the company has to benefit from higher oil prices. That's just the price of admission. Second, and this is critical, it needs domestic production. You want a company drilling in Texas, not one that's exposed to the exact same disruptions happening overseas. Third, a strong balance sheet. Low debt is like a shock absorber. It means a company can survive if prices suddenly fall back down. And finally, it should pay you to wait. A solid dividend or a stock buyback gives you a return even if the stock just trades sideways for a while. That is the profile of a truly resilient company. But what's really interesting here is that these strikes, they aren't happening in a vacuum. You gotta zoom out. They're actually an accelerator for a much bigger trend that was already happening, a massive rotation of capital out of speculative growth stocks and into hard assets like energy. And if you want proof, you don't have to look any further than the tech sector. Jack Dorsey's company Block just announced huge layoffs, and critics are calling it AI washing, basically using the hype around AI as an excuse for a much deeper, more painful corporate restructuring. And the scale of this is just staggering. We're talking about roughly 4,000 jobs being cut. That is nearly half of the entire company. This is a massive red flag, a clear signal of some pretty significant structural pressure on a major tech and growth name. So let's connect the dots here. You have deep weakness showing up in a tech darling like Block at the exact same moment you have a huge surge of interest in tangible, cash-flowing energy companies. That's not a coincidence, folks. That's the market reallocating capital in real time. And here's one more data point for you, this time from the consumer side of things. Tesla just hiked the price of its Cybertruck by $10,000. That's a nearly 17% jump. Now, on the surface, you might think, hey, that's bullish for Tesla. But if you dig a little deeper, it's actually a potential warning sign for the consumer economy. What a move like this really signals is potential weakness in consumer discretionary spending. When you see massive price hikes on high ticket items at a time of shaky economic confidence, it just reinforces the market's preference for essentials, like energy over wants. It's just one more reason capital is flowing toward hard assets. So let's wrap all this up. The key lesson today isn't just about Iran or oil prices. It's about having a strategic playbook ready to go before a crisis hits. That way you can actually find opportunity in the chaos instead of just reacting to it. Look, at the end of the day, it really boils down to this. Panic is an emotion. It's a gut reaction. A plan, using a framework just like the one we talked about, is a strategic advantage. The question isn't just about how you handle today's market, but how you're going to be prepared for the next inevitable shock. So which one will you have?